Hey everyone, on Thursday I saw this headline. The Dow and the S&P 500 flashed red today. And I thought, what does that mean? Today I'm going to explain to you what a market index is, what the Dow and S&P 500 are and are not, and what it means for our economy when they're doing poorly. Earlier this week, the Dow was more than 200 points or 0.9% lower, while the S&P 500 fell 0.5%. This was a reaction to our continued economic struggles and a recent GDP report by the US Bureau of Economic Analysis, which showed that our GDP contracted 32.9% from April to June, wiping out 5 years of economic gains in just a few months. Clearly, the US economic recovery is stumbling, or is it? Can we make that conclusion based on the Dow and S&P 500? Dow and S&P are both market indexes. A market index is a hypothetical portfolio of investment holdings that represents a segment of the financial market. The calculation of the index comes from the prices of the underlying holdings, so it's something economists or people create to track a segment of the market. The Dow Jones Industrial Average is simply the average value of 30 large industrial companies that have been around for a long time, like General Motors, Goodyear, IBM, and Exxon. On the other hand, the S&P 500 tracks an index of the 500 largest US publicly traded companies. So that's all an index really is. It's a collection of companies that we lump together and track because we deem that grouping or indexing them together gives us some type of valuable information. We could create a new market index right now called the Green Index that tracks the performance of all companies that have green in their company logo if we thought that was useful in some way. Other popular indexes include the Russell 1000, which is the top 1,000 companies by market capitalization. US Aggregate Bond Index tracks bonds. S&P Midcap 400 tracks midcap companies, which are equities between capitalizations of 2.4 and 8.2 billion. The large cap stocks that make up the S&P 500 are generally companies with a market cap of over $10 billion and represent 80% of the US equities market by capitalization. This is why it's the investor's preferred index because it tracks so many more companies and is way more representative of the US market when you compare it to other indexes. The S&P 500 also has a weighting method that gives a higher weight to companies with larger market capitalizations, which means companies that are worth more, while the Dow gives company with higher stock prices a higher weighting. This means that Dow companies with lower market capitalizations, meaning they're worth less as a whole, could still get weighted more within the index if they have a higher stock price. Even as the Dow and S&P 500 took a hit today, the Nasdaq Composite Index went up. The Nasdaq is an index that tracks over 2,500 companies. 48% of them are tech, which include Google, Facebook, Apple, and all the sexy tech stock that people like to talk about. One thing this recession has taught us is that while America is having difficulties, major tech companies are not and seem to be unaffected or almost have an inverse correlation to the rest of our economy. As more people stay at home, people are relying more and more on the products of these tech titans, and they are still growing. So even though the Dow dropped and the S&P dropped, it doesn't necessarily mean you are in trouble as an investor if you have invested more in tech stocks. Another downside of the S&P 500 index is certain companies can become significantly overvalued or undervalued, and that could skew the index. For example, Apple currently represents 3% of the total index. If one day Apple stocks grew 50%, that could shift the whole index, even if the index as a whole wasn't doing that well. So what does this mean for us investors and people trying to stay afloat in the economy? Honestly, it's really hard to tell. What I think this means, and I am not a financial advisor or a professional of any sort, so please do not listen to me. This is just my opinion, and my opinion is we all need to be very careful. Make sure you are diversified across all sectors. Putting heavier into tech stock would be a reasonable move when compared to other sectors, but even that is not guaranteed as people can't continue to use a lot of tech services if they can't pay for their internet. That would be a worst case scenario, but based on our current trajectory, I think we are in for some painful downturns before we can recover. I do have faith in an eventual recovery as history has shown that the markets eventually always do recover, but these are unprecedented times, so for most people, I think the best bet is to just be careful and conservative with your money. Holding some cash wouldn't be the worst idea as long as you're okay with missing out on some very erratic gains. That's all I got. I just really wanted to explain what the Dow and S&P 500 are since we'll be seeing it on the news a lot. lot, and we have been, and they are very, very important metrics, but they don't represent everything that's happening in the economy. Please like and subscribe if that was helpful, and let me know what other topics you'd like me to talk about. I've been watching the news and staring at my portfolio every day, and it's just a freaking roller coaster. Take care, be safe, and I'll see you all next time. How's your portfolio doing? Mine is hanging in there, but it feels like we are walking on the world's thinnest tightrope.